earlier promised, I want just to introduce consolidation or simply group accounts. So the first thing that you may need to know are some of the key terms associated with consolidation. The first one is what we call a parent company. A parent company is a company that controls another company, and the company that is controlled is known as a subsidiary. The example that I can give is if you look at Zambif. Zambif is a parent company, and under Zambif it has got a number of subsidiaries such as Zamchick, Novatech, Zamleather, and all the other companies. So those are called the subsidiaries. Then you'd also need to know what is an associate. Now, an associate is a company where the investor has significant influence. So the most important thing to know is in every given question, obviously, you'll have the parent company, but then one of them could be a subsidiary, and then the other one an associate. Now, the whole purpose of consolidating is to be able to report as a single economic entity, meaning that you get the results of the parent company, you add the results of the subsidiary. So that put together, that's what we call group accounts or consolidated. Just like as I said earlier on, if you look at Zambif, Zambif has got its own activities. At the end of the year, it prepares all the full set of financial statements. That's what they do. And then also the subsidiaries as well, they have their own financial statements. So to consolidate, therefore, is basically to get the results of the parent plus all the subsidiaries so that we can report as a group. So I would want just to quickly read through this basic example. This would help us to develop the capacity for the next question. So example 1 reads, Petros acquired 80% of the shares in Sidin for 400. Now already here it gives you a picture that Sidin is a subsidiary. Any company where you have 50 plus 1% shareholding is a subsidiary. Okay, and we are told at that time, when the Sidin's retained earnings amounted 25 and the share premium 30, the same company also, Petro, acquired 40% of the shares in Alex. So in this case, Alex is called an associate. Okay, so this should give us this. So this question would help us to consolidate a subsidiary as well as an associate. Now, as earlier mentioned, a subsidiary is a company that you are controlling, and control comes in as a result of having the majority shareholding, that is 50 plus 1%. So in the case of Sidin, we actually have 80%. So we are controlling. So Sidin is a subsidiary of Petros. And in Petro acquired 40 in Alex, so 40%. So here you have what we call significant influence. There's no control, but you can influence. Okay, so this is what we have. And then we are given the financial statements. That's, I think, a year later. So you notice the first company, that is Petro. Petros is a parent company. Sidin is a subsidiary. Alex is an associate. So when you look at information of this nature, you shouldn't be scared because the one that you are controlling is SIDIN. So therefore, even when we are going to consolidate, our focus will be on Petro and SIDIN. Okay, these are the two that, of course, we'll look at. So our focus will be on the two, Petro and SIDIN. If anything, the associate, you can even cross those results. You know, they are not okay. So we can try to, when you do that in the exam, I think psychologically to prepare your mind, because in Alex, as earlier mentioned, you are not controlling it. What we have is what we call significant influence. So therefore, our concentration will be on with Petro and SIDIN. So let's just get down and see what is there. Okay, we have to look at the requirements. You are required to prepare the consolidated statement, financial statement. We need to consolidate. That is at the end of the year. But then we also have some additional information. One, Petro sold goods to SIDIN costing 20 at a markup of 25%. And then at the year end, 3/4 of the goods were still in inventory. Then 2, SIDIN had a plant and machinery with a fair value of 100, which was not incorporated at the date of acquisition. And the group policy is to charge depreciation at 15% on cost. So we are going to consolidate. Now, as we consolidate, there are a number of workings that we need to do. So in the next 20 minutes, I want us to focus on the workings, so that you understand how to consolidate. So this question would help you just to appreciate, the basic principles of consolidation. So we have a number of workings. So we will start with working number 1, which we call the group structure. So W1. So I want us to look at the group structure. This is very important because it will help us to understand so how you do it. You start with Petro as a parent company, then you draw an arrow down straight. Okay, then you have SIDIN, that is the subsidiary. You remember we have 80%, so 80%, and Petros in Alex, that is Alex, 40%. So even below there, under SIDIN, you can indicate sub. So that's SIDIN is a subsidiary, so you can say sub. SIDIN is a sub. Then Alex, associate. Great. Now, even from the structure, this should tell you. Now, take note how the structure has been drawn. From Petro, it's a straight line downwards, indicating the control. And then you, from Petro to SIDIN, some kind of an arm, indicating the significant influence. Okay, so that is an associate. So now, once you've established the structure, it now helps you to have the direction. So therefore, the next working number 2, we go to working 2, that is the net assets. So working 2, you move to we move to the net assets. So net assets ensure that we are going to specify, you indicate the net assets at acquisition date, as well as net asset at reporting date. Okay, so let that okay, so this is very important. Now, probably for the sake of understanding, these net assets are relating to the subsidiary, so you can just say net asset dash seeding. Okay, so these are net asset for the subsidiary. Okay, great. So that's what we are looking at. Now, what is making up the net assets? It's so we can get to the, okay, you got your to seeding. So let's get to seeding. Under seeding, you check your share capital for seeding. Share capital for seeding, we have 250. The share premium, you have 30. Retained earnings, you have 115. So now, this is the area where you concentrate. Remember, when you are acquiring shares in the company, or you are taking control, it's actually the shareholding, or the net assets that you are taking that are represented. The heading says net assets, but these are represented by the share capital, share premium. Now, we've specified, we've said at the date of acquisition, as well as at a reporting date. Now, what you see in the financial statements, these are assets at the date of reporting. So this is a reporting date. But then for capital and share premium, this one will be constant. That is both date of acquisition as well as reporting. You'll have the same amount. So 250, 250. Share premium 30. But then for the retained earnings, let's just go a little bit up there on the first paragraph. Petro, we are told Petro acquired 80% of the shares in Seeding for 400 on the 1st of April, at the time when Seeding's retained earnings amounted to 25. So the 25, this is a retained earnings at the date of acquisition. Similarly, even the share premium also, we had 30 as well at the date of acquisition. But when you come in the financials in here, you find also share premium 30, indicating that there was no movement. But the retained earnings would move from 25 and then to 115. Great. Then let's also, so let's go to the solution. Let's get to the solution. Okay, the net assets. So you come in here. So you have share capital. So share capital, the 250. As I mentioned, this is constant. At the date of acquisition and reporting, you have the same amount. You also have the share premium, also constant, 30. Retained earnings. Remember from the first paragraph, we had a 25, and then at reporting date 115. Okay. Now there is another adjustment there, which we call the fair value. So we can just a fair value adjustment. I'll show you where the figure is coming from. So fair value adjustment. Date of acquisition 100. Reporting the same amount 100. Then depreciation. Here you can open brackets. 100 times 15%. We were told the dip is 15%. Again, that will give us a 15 at the reporting date in brackets, because it will be reducing the, okay, then you can get the totals now under each item. Okay, under the first one we have 405, that's the total. Then 480. Then you can also get the difference between the two, 480 and 405. That will give you 75. Now this 75 is known as the post acquisition profit, post acquisition profit. Now I would want first to go to the fair value adjustment. So let's get to the question. Okay, just below the question at the end. Okay, note 2 or bullet point number 2 says Seeding had a plant and machinery with a fair value of 100, which was not incorporated at the date of acquisition. So you're saying at the date you are acquiring this company, these guys have assets that are with a fair value of 100. So we have to incorporate it. No wonder at date of acquisition we are adding it, even at reporting, except that at the reporting date it would have lost value by 15% because you depreciate at the end of the year. Okay, that's how we have that. So let's get to the solution. Okay, so that's how we have the 100. So check date of acquisition, we have 100 at acquisition date, then also reporting 100. But then at the end of the year, because you have lost value, so you put 15 in brackets, so that ideally we are talking about 85. So the value of the asset will be 45 at the reporting date. That's the year end. Then the difference between 480 and 405, the 75, we call it the post acquisition profit, or simply the PAP, which is the profit after acquiring, the organization. Now alternatively, this is how it can be calculated. Just check on this working, the retained earnings working per reporting date. We have 115. So this is the retained earnings at the date we are reporting. Now you need to understand that profit is cumulative, meaning the profit we found at the date of acquisition is also sitting in there, which is the 25 there. So to get the post, that's the profit after, you say 115 minus 25, that will give you 90. But then there's also depreciation. Dip also reduces the same, so 90 minus 15, so that will still give us 75. So this is the profit after acquiring, the entity. So that's a profit, post acquisition profit. And this is what we are interested in, because if at the time of acquiring the subsidiary you had 115 cumulative in terms of profits, you need to take out what you found, so that you can only report the profit acquired after the date of acquisition. This is a very important working. You see from this working, a lot of things would actually come from from here. Great. So therefore we go to the next working, working number 3. We go to working number 3. That is goodwill. Goodwill. Quickly there you say purchase consideration. Purchase consideration. Purchase consideration. Purchase consideration. 400. I'll show you where this is coming from. Then less net assets at acquisition date. That's W2. So in there we have 405 times 80%. That gives us 324. You deduct, we have 76. So this is the goodwill. Now quickly I want us to, let's get to the question and show you where the figures are coming from. Okay, we can just check on top there. The first line told us that Petros acquired 80% of the shares in Seeding for 400. So that 400 is the purchase consideration, that you paid to acquire shares in Seeding. So that's the amount that you paid. Alternatively, if it's not given right in there, you can still find it in the financial statements under non-current assets. We have here under investment in Seeding, we have a 400. So sometimes they may be silent there, but you can still pick it here. Okay, so meaning that Seeding paid, or rather Petro paid 400 to acquire the shares in Seeding. Now let's also go down there on the notes below there. Note bullet point, the last one, it says goodwill is on a proportionate basis. Okay, so on a proportionate basis. So I'll explain what that means. So now we can go back to our solution. Go back to our solution. Okay. So now I want us to look at how we calculate the goodwill. First and foremost, I would want to say that goodwill is basically, the difference between the amount you pay to acquire and the separable, identifiable assets of the company. So in this case, you paid a $400,000, and remember your net assets. So let's go to working number 2. You see that is where that is coming from. So these were the net assets we had at the date the company was acquired. So please take note that goodwill is computed at the date the company is acquired. That's how it is calculated. But then for this company, we didn't acquire 100%, we had 80%. So simply do 80% of the 405. Those will be the assets. So we can we'll go to that working. So when we come in here, from the 405 asset, for us, we only got an 80%, which is equivalent to 324. So in other words, we are saying in this, the assets in this company were actually valued at 324, but we've been made to pay 400. So meaning that which we've paid over and above the 324, that's what we call the goodwill. Remember, goodwill is an intangible asset. Okay, so every time you buy off a business, obviously the other assets, of course, will be reflected, will be given to you. But then goodwill, of course, so anything, because you can't just pay. Imagine they tell you that, okay, you are buying a company like ShopRite. They have to look at the buildings, the inventory, the equipment, everything, value them. Maybe with that to come to 324. But then you are told pay 400. So it means that which you are paying over and above, that's what we call the goodwill. Okay, so take note of that. So this is a proportionate method. Okay, that's a proportionate method, because we also have what we call a full goodwill. So take note of the proportionate. What it means here is obviously we've only paid this company, we acquired 40%, 80% sort of the shares in that company. And we're also comparing with the assets also that we've acquired. So we're just working on the basis of what we have in that company. So that's called a proportionate method. So take note of that. Then we move to the next working, as working number 4. So we go to working number 4. Okay, so working number 4, there is what we call provision for unrealized profit. Provision for unrealized profit, or simply PRP. One thing that I want to mention is that the parent, the subsidiary, they'll always have transaction. They'll transact amongst themselves. That is, the parent may sell to the subsidiary, the sub may also sell to the parent company. But then the concept of unrealized comes in a situation where the inventory that were sold by either party side are still, held by the party that bought those goods, that is at the year end. So in that case, we call that unrealized profit. I'll give an example. Here's where you have a parent company. It has goods, for example, costing 100. Then it sells the goods to the subsidiary for 120. So what would happen is the inventory of the parent will reduce by 100. But for that of the subsidiary, the one that has bought, it will increase by 120. And then also the parent would have recorded a profit of 20 kwacha. But if you are told that by the year end, the subsidiary still kept those inventory, so it means that that profit is not yet recognized, rather realized, because these goods are still traceable. They are still within the group. The principle states that as long as goods are within the group, there is no realization, because at the end of the year, when you are consolidating, the parent will get its total inventory, add to that of the subsidiary. So you may find that the inventory on the part of the selling part would have reduced, but would have increased on the buying part. So at the end of the day, you find that these are still within. So therefore, you cannot realize any profit because the goods are still within. But of course, if the goods are sold outside, then you can, recognize the profit that has come from that transaction. But apparently, there is no profit. Therefore, the treatment is to reverse the unrealized profit. So quickly, let's do this working. I want to show you something. So 25 over 100 times 20 times 3 over 4, or 3 quarters. This giving us 3.75. 3.75. Then here would debit the other leg, gonna debit the retained earnings, and credit inventory. Please take note of this particular treatment. At this level, we all know that profit has got a credit balance. Okay. Inventory has a debit balance. So what we are trying to do is, if the profits or the retained earnings, we are saying these are unrealized profits. So meaning that on the part that sold, in this case it's a parent, it actually sold. So what we are saying is that this unrealized profit of 3.75, it has to be reversed by debiting the retained earnings, because retained earnings has got a credit balance. So by debiting, you are reducing. Inventory too has a debit balance. So by crediting, you are reducing the inventory, because we realize that these goods are still within the group. Now, if you look at the note, it says these guys, they sold goods costing 20 kwacha at a markup of 25%, and that at the end of the year, 3/4 of the goods were still held by the subsidiary. So it means that 3/4 of the goods and even the profit is not yet realized. So the first part is we calculate the profit, 25 over 100 times 20, that will give you 5. That's the total profit on this transaction. Then out of that $5 profit, we can simply say only a quarter has been sold, and when outside, therefore that become realized. So your interest here is not to look at what has been realized, but the unrealized one, what is still remaining. Okay, so you still have 3/4 of the goods still within, therefore that profit element has to be removed, reversed by debiting the retained earnings and crediting the inventory. Now the double entry for unrealized profit will still remain as it is. You debit, return any credit inventory regardless of the party that has transacted. So take note of this adjustment. Then we can make some progress. We go to working number 5. Working number 5. The non-controlling interest, commonly known as NCI. NCI. So this one will go to show you where it's coming from. So you write net asset at reporting date from working number 2. Net asset at reporting date. From W2, that's 480. Then we're going to multiply this with the NCI percent. NCI percent, which is 20%. That's giving us 96. Okay, so that is now let's get to working number 1. Want to show you something. Look at this working number 1. Petro acquired 80% of the shares in Sedin. So it means if you have 80%, you have the controlling interest, and the 20%, therefore it belongs to the non-controlling interest. So this is how we get the non-controlling interest. Of course, the 80% from 100, it leaves us with the 20%. So now, previously we were actually calling this as the minority interest, because the total stake shares in the company is 100. So if you have 80, then there is a group of shareholder, called the non-controlling interest, who are holding 20%, and we still need to calculate them as well. So let's get to that working number 5. Working 5. Okay. So what we do here is the non-controlling interest. Remember I said these are shareholders, except these are the minority. So from the net asset that you have, we've quoted the working. So let's just go to working 2 just to see something. Let's go back to our working 2. Yes, working to the 400 at reporting date. So that's where you base your non-controlling interest. These guys are shareholders. So from the total assets that they have, they also have 20% belongs to them. Okay, so we get there. Okay, great. So that's how we calculate the non-controlling interest. We make progress. We go to working number 6. Working 6 is the group retained earnings. Group retained earnings. We want to look at the total profit for the group. Okay, so you can quickly indicate Petros, Sidin, Alex, okay. So what we, okay, let's fill in the figures. So Sidin, working number 2, W2. From working number 2, we have 75 times 80%. That gives us 60. For Alex, 40 minus 12 times 40%. That gives us 11.2. Then provision for unrealized profit, PRP, working number 4. $3.75, giving us a total of 255.45. Okay. Now, I want you to see where these figures are coming from. So we go to the financial statement of financial position. Retain the earnings. Let's check. Okay, just below the share premium. That's the one for the parent. We have 188. That's 188. Okay, that's what we are picking. So for the parent to get everything, show this 100%. But then you notice in the same line, we also have retained earnings for Sidin, but this one is at the reporting date. We are interested in the profit we made after acquiring it. So that one, we find it in working number 2. Then also for Sidin associate here, we are just interested in our profit, but at the date we acquired this Sidin, it had retained earnings of 12. So again, what to do? This 12 is already sitting in there. So say 12 from 40. Then whatever remains, we multiply by the 40% shareholding that we have. So that's what we are going to share. Great. So we've let's get to the working. Okay. So from the working here, you've seen Petros. So Petros, ideally, you are getting 100%. So Petros is everything. That's a parent company. So we have 100%. Great. Then for Sidin, our interest is the profit after acquiring it, post-acquisition profit, which is 75. But of this 75, our share as a parent is 80%, giving us 60. Alex as well, at reporting you at the 12, date of acquisition 12. So you get a difference by 40% the holding you have. That gives you 11.2. Now, for this one, PRP, remember we said we are going to debit retained earnings. So that's the debit so that we can reduce the profit, because that this is unrealized. Okay, so that's what we have here in working number 4. We are debiting the retained, and no wonder it is in it's in brackets. Then that takes us to the last working, but not least, of course, investment in associate. Okay, investment in associate. Okay. Now, this is the only working that you do for an associate. Remember, I told you we don't waste time on consolidating an associate. So we will start first with cost of investment. Let's first get the figures down, then I will show you where these are coming from. Cost of investment in the associate, cost of investment 250. Then you add the profit share. Add the profit share, 11.2. Okay, total 261.2. Right. Now let me show you this cost of investment. Let's get to the question. Just up there. Okay. Remember, Petro acquired 40% of the shares in Alex for 250. That's the amount that you paid. And then also here, it's not given there, you can see we have investment in Alex here. That's also 250. So as indicated, we are not going to consolidate the results of the associate. Reason being that we only have what we call significant influence. So what we are just going to do is to get the amount 250 that is in the records of the parent company. That's our investment. So seeing we have invested 250, but of course our shareholding could not give us a control. So when we consolidate, we're just gonna get this 250 plus the profit that the company made. You remember this guy had retained earnings of 40 and less the one at the date of acquisition, the 12. Okay, which gives you 28. It's already indicated there 28. Then times 40%, that is 11.2. Okay. So it's just 250 plus 11.2, so 261.2. That's what you have in that working. Okay, so that's the only thing that we are going to consolidate. The rest of whatever we have there, drop everything. Don't bring anything. So it will just be between the parent and the subsidiary. So at this level, we can now consolidate our financial statement. So we have about 3 minutes to get our consolidation. Okay, so we now going to do our Petros consolidated statement of financial position. Okay, so we have non-current assets. So under here we have the PPE. Open brackets, I'll show you the figures. So we have, for the parent we have 50, the subsidiary 140. Here is just adding. Okay. Then the 100, that is the fair value adjustment which was left out, minus the 15, the depreciation. Total will be 275. But ensure that you don't consolidate an associate. Then so let's get back to the question. I show you something. Okay. So ideally what we are doing is the PPE for the parent is 50 plus the subsidiary 140. So it's 50 plus 140. Then plus the fair value adjustment, that 100, which we had in the notes, 100 less the depreciation of 15, which was so that's how we come to that figure. But leave out the one which is relating to the associate. We can also still get to the next line up there. Okay, so now look at the next line. We've got investment in CD in 400. Now don't consolidate this 400. Remember, in calculating goodwill, this was our purchase consideration. So that has been absorbed in the goodwill working. So therefore, let's just go to the goodwill working. You see what we, okay, we use that 400, netted off against the assets. So we have a 76, so that's what we bring in there. So goodwill from working number 3. Now take note that I'm endeavoring to make references to the notes, the working, so that it's easier. Then investment in associate. This is the only line that you have for an associate. What we've actually invested. Okay, we already worked out that in working number 7. So 261, yes, from here. So 261.2. Then you get a total 612.2. Okay, then we move to the current assets. Current assets. So under current assets, you have inventory, open brackets, the parent 40, subsidiary 100, minus the unrealized profit. Remember that journal where we said we debit, return, ends, and create inventory. Okay, so that will give us 136.25. 136.25. Then trade receivables. Trade receivables. Again, open brackets. The one for the parent is 70 plus 120 minus 12. Now, okay, right, I'll show you where this 12 is coming from. The 12 is the intercompany debt. Let's go to the working, the questions just at the end. Bullet point number 3, it says Sidin was owing $12 to Petros at the year end. Okay, so in this case we are now consolidating. So it means in the books of Sidin, this was a liability. In the books of Petros, this is an asset. But since we are coming up with a single statement, there must be a cancellation of these intra-group debts. So what we are going to do is from the receivables, you deduct the 12. From the payables, you also deduct a 12. Because remember, we are coming up with a single statement. Therefore, any intra-group debts are cancelled out on consolidation. So we can go to that part of the question. Okay, that's why we have the 12. Then the cash, open brackets, that's the parent 27, subsidiary 95, total 122. You add those, that gives us 436.25. Okay. Okay, then the total of that, total assets, 1048.45. Okay. Then we go down. Capital, and liabilities. So here we have the share capital. You just get for the parent company. I'll explain why for the sub. Then share premium, also for the parent. Then the retained earnings, W6, we've already done the working. Non-controlling interest equally, we already have working as NCI working 5. We have a 96, the total 791.45. 791.45. Okay, the non-current liabilities, we have 10% loan notes. You just add for the two, parent plus sub. Okay, that's 86. Deferred tax, $67 plus 9, that's 76. The total of that is 162. Then finally, current liabilities. Trade payables. $40 plus 27. Then minus the 12, the intercompany debt, the one that we deducted from the receivables, that's 55. Then taxation, Parent plus subsidiary. Parent plus sub. That's 20. Accruals 18 plus 2. That's 20. Total 95. Okay. Then your total 1048.45. So this is the consolidated statement of financial position for this organization. So this is to help you to appreciate the basic mechanism on how to consolidate the financial statements. Just maybe a comment on what we have, what we've prepared. I mentioned that the share capital for the subsidiary is not brought into. You only bring it just for the parent. Okay. Just for the parent and the premium. Now we can go and check want to show you something on the question. Okay. When you get on the part of the question, remember the investment in seeding the 400, which we use in the goodwill calculation, and then we deducted the net assets. Now the net assets were represented by the share capital, which was the item that are sitting under here. So basically that was the cancellation, purchase consideration less the net asset, which is made up of that. So that's why we only brought in just the goodwill. Okay, so when you consolidate, you only bring in the share capital just for the parent company. The other one, those other two, because these are asset, debit balance, credit balance. So the netting off, that's what gave us the goodwill of 76. So ideally drop them. And also, as you said, an associate, don't do anything there. It's only one line here. That's what we are gonna add as we consolidate. Okay. So this was just meant to help you to have an idea. So I would want you to go through this tonight, and then tomorrow we'll still have other questions flowing that direction. So let's make good use of them. Thank you so much. Have a blessed day.